guest says we could see volatility in the near term, and that could offer up opportunities for investors. Let's bring in John Stoltzfus, Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to see you.
Thanks for having me on the show, Andy. Good
so you think in the near term we could see some sell-offs and they would be opportunities for investors?
Oh, we always think there could be some volatility. You never know what piece of data crosses the transom that could rattle traders and cause some volatility, or a sudden feel that technicals or robotics were pointing to some overvaluation level. But that said, it does appear we are very well right now within a bull market move that is driven by both the Federal Reserve's being very sensitive and not pushing the economy into a recession while it works to curb inflation, and then business really managing to navigate tougher environments, good earnings, and the consumer, while slowing, still showing considerable resilience and job growth. So it looks like there's more driving this market than just emotion or a sentiment.
That's interesting. So there's good reason to be buying stocks right now.
We believe so, and we think it's a trend that recognizes not just fear and greed, but rather the need for exposure to businesses that have opportunity to benefit not just from AI, but from technology, from the change that we're seeing in the global supply chain, essentially a globalization, not just a reshoring, but a reshoring to different places in countries, whether it's Mexico, Vietnam, Brazil, or Korea or Japan, for example, and both developed and international emerging markets.
What about this much lamented concentration of the market where the S&P is being lifted higher by just a few stocks? Does that worry you?
You know, it certainly is something we observe, and we recommend broad diversification when it comes to the S&P 500, not only in technology, but we like financials, we like industrials, consumer discretionary. We don't overweight consumer staples, but we certainly have better exposure to consumer staples, so we don't avoid them. We even own some utilities. There's opportunity in healthcare and energy. There's plenty of opportunity. The concentration from a perspective of the traders would seem to be particularly emphasized, to put it mildly, in technology. But much of that because the earnings growth has been so spectacular, even in the first quarter of this year. While earnings growth for the S&P 500 is up about 7.9%, on back of around 3.9%, 3.7% revenue growth. It was spectacular double-digit earnings growth by communication services and information technology, but also financials but to a lesser degree, and also to consumer discretionary and utilities. So we think the broad nature of this bull market from the end of October last year through now shows the broader diversification. We had some broad diversification at the beginning of the year, and then it narrowed. This will likely flow into a more diversified picture, we think, going forward.
If there is a U.S. recession, will that be bad for the stock market? That's a given, I suppose, that some domestically focused companies will suffer.
Well, we would have to think that a recession is certainly not something that's desirable. But we would point out that this now, I think it's now 11 rate hikes and 8 pauses within the Fed funds hike cycle through 19 FOMC meetings since March of 2022 have yet to result in a recession in the U.S. And we think that what it is while the dramatic increase in interest rates went from, in terms of the Fed funds rate, from a broadband of 0 to 0.25%, the Fed funds rate now stands at 5.25 to 5.5. Yet historically, that level of Fed funds rate is not detrimental to stocks going up. What it does cause is a desire for quality stocks over stocks that are not high quality. So you need positive cash flow, profitability. Gosh, that sounds like technology, sounds like large cap financials, sounds like selective names within consumer discretionary and in the overall index. Not, there's lots of opportunity here that suggest, if we look at job growth, job postings, job growth has slowed, but the JOLTS index from the Fed is still at a very high level compared to more normal times. But on interest rates, 4.5% to as low as 3.8, probably pretty normal for an environment where bond issuers pay for the privilege of borrowing money rather than an environment of free money, which is what we had for most of the 16 years from the great financial crisis through the pandemic and until 2022.
Yeah, it's so strange that we had all that cheap or free money for years.
You know, it was strange, but when we look back, the depth of the financial crisis, the way it affected financial institutions that were not only stateside but global, and what it did to residential real estate in particular, and then the pandemic were extraordinary events, which if the Federal Reserve had not taken the role it took to provide extreme liquidity, we might have not only gone into a deep recession, but perhaps even a depression. And that was avoided. So we credit the Fed for the prosperity that we've been able to retain over these years with significant challenge. And we think their ability of what they've done, we're one of the few firms, I think, that says the Fed has really been our friend if you consider the way they've operated right on through 2022. And they're a bit behind the curve, but now they caught up. They have essentially acknowledged that inflation is sticky, but they've been remarkably sensitive at applying their mandate to curb inflation while bringing it down, not causing a recession.